The great financial crisis hit in the year 2008, and we had this ludicrous situation where a barber was having 5 homes. How could a barber who was probably making about $15 per haircut in 2008, it wasn't that expensive, in Florida, how could that person afford 5 homes? Somewhere something had gone horribly wrong, the math had gone horribly wrong, and this led to a lot of homes coming into the marketplace. When all these came to the marketplace, people thought there would be a collapse of the real estate in the United States. But that did not happen. As a matter of fact, between 2010 and 2014, most of these houses just disappeared from the market. In other words, they were no longer up for sale. There was a small period of time where many homes went for distress sales, but suddenly it all stopped. What happened? Who stepped in? And what is happening to all those houses that went off the market so suddenly in 2010? This infographic explains what happened, how a new industry was born in the United States, and also a hint on perhaps where the money out of shadow banking is going in. Whether this is going to be a big problem for the economy moving forward, only time can tell, but it's useful to see what really happened in 2010. Here we go. A small request as always to please like our video, and if you have not already subscribed to our channel, do subscribe to our channel. Here we go. So the great financial crisis opportunity resulted in the availability in the market across the United States of close to 200,000 plus homes, most of them single family homes, and this created a historic opportunity for large private equity firms to enter the housing market at scale, purchasing foreclosed homes for a fraction of their price and in bulk with cash. Suddenly banks became whole again, and I think there was a wink wink nod nod kind of a situation. The banks were going to fail, and I think the Treasury Department, hammering Hank, said okay, it's fine as long as they get some money off to write off all these books that were unpayable loans on their books, on the bank's books. So let's take a quick look at what is the extent of this and how it has evolved now. So what was the investor playbook? From acquisition to asset. Suddenly these things, instead of becoming just an acquired house for cash, they suddenly became an asset. These big private equity firms did not flip the homes because there was no market for homes. What did they do instead? They executed a long-term strategy, transforming individual properties into a large-scale, professionally managed rental business. I'm not saying this happened, but think 2021. Biden comes into power. Guess what happens? Lots of illegal immigrants are brought in. And where were they housed? Well, this created an opportunity for all these people sitting on these thousands of homes to let them out to the government for a hefty fee. You know, the Roosevelt Hotel in New York, owned by Pakistan, was doing this. So this could be one reason why the Biden administration did that. See, a lot of people put in a lot of money for a candidate to win, and when that happens, the candidate is expected to pay back the dues. And these could be one of those things. I'm not saying it happened. Maybe some investigation needs to be done. But you see how people sitting on thousands of homes have now been able to, not only break even, perhaps they've even turned a profit. It was a 3-step process. First, acquisition. In the period 2010 to 2014, they purchased hundreds of thousands of foreclosed homes at distressed prices, often in bulk at auctions. Then from 2015 to now, they are monetizing it. And how are they doing it? They renovated the homes and converted these properties into professionally managed rentals, generating consistent cash flow. How can it generate consistent cash flow unless you have people residing there? Well, that's where the interesting question is. If cities were overbuilt, and where were the people from? So that is a question that perhaps needs to be answered at a later date. More research and digging needs to be done, and I'll do that. Just give me some time and we'll come back on that. Third, now what happened then is these professionally managed rentals, they don't want to keep it for too long. They want to dispose it off in the market. They sold these portfolios in bulk to other institutional investors or secured them as REIT, real estate investment trust, locking them into the rental market. Ergo, a new market, a new type of market has been born. The vast majority of homes were not sold back to individual buyers. They were either held or sold to other large investors, keeping them as rental properties. Let's see. This is sold to other investors about 25%. About 70% are still held by the original investor, and about 5% of the homes were sold to individuals. That's the breakup. Now, how is the value built on these distressed priced homes? The property value is no longer tied to their low purchase price. So this is where the sleight of hand comes in. It is overwhelmingly driven by their performance as rental assets. Suddenly it has metamorphosized into a rental asset company. And how much is it? Let's take a look at it. Market appreciation is about 40%, then rental yield is about 50%, and financial and management efficiencies have given about 10% of the valuation. So all these things are, suddenly you have thrown away houses that were not sellable in the market, suddenly turned them around, labeled them as something else, and suddenly a new market type of homes has been born, rental homes. And this new valuation model has shifted from a one-time purchase price to a long-term income stream. So the myth is that these things are still being held on their books on par value. It's not true. The original cost is very, very low. They are not holding it there, but the reality is they are looking at the income potential and they are saying this is the fair market value of this home, and they are valuing on rental yield, NOI, and rent growth. NOI is net operating income. That is like rental money got minus all the maintenance fees, the overheads for maintaining, like for example, an estate management company and so on and so forth. And let us take a look at the rent growth. The interesting thing is, what used to be 100%, if you assume that 2012 you're paying $100 per month, today the same house is fetching, at the end of 2024 I should say, it is fetching close to $185. An 80% increase. That's huge. So this means that high occupancy rates are there, consistent rent growth is happening, and this demonstrates the portfolio's robust financial performance, justifying a high valuation. I'd be very curious to know how the numbers for 2025 look, because I have a feeling many of the people who were illegal were also housed in these places, and I think that money, that gravy train has stopped, and I'll be curious to know what is happening now. The other interesting thing is these places proclaim that they have a 95+ percentage occupancy rate. That's very impressive. I don't think even hotels have that kind of an occupancy rate. You can go and check that. So I am really impressed. So there is something here that is happening to the entire real estate market in the United States that at least I don't understand. See, you have a permanent market shift. The homes bought by investors during the crisis have, completely been categorized and bundled as a new asset class, and those things appear to be making a lot of money until something is going to go wrong. Well, is it? If there is going to be a financial recession, will these things also get affected? Only time will tell. I have a gut feeling that it will, but at the same time, let's not be so pessimistic. Let's wait and see what happens. Thanks for watching. Please like, share, and subscribe to our channel. Don't forget to click on the bell button for notifications. Namaskar.